Welcome to this market update. Today we'll talk about the key themes shaping markets as we enter the final quarter of 2025. We'll look at why stock prices have climbed to very high levels, what the Fed's recent rate cuts mean for you, and how to think about uncertainty in today's markets. These topics are important right now because markets are sending mixed signals. Stock prices are hitting new highs while economic data shows some signs of weakness. It's like your car dashboard showing the gas tank is full while the check engine light is also on. Just confusing signals that deserve a closer look. So understanding these dynamics can help you stay calm during uncertain times. This chart shows the Shiller Price-to-Earnings ratio for the S&P 500. It's approaching levels we last saw during the dot-com bubble of the late 1990s. And for those who remember, that bubble didn't end particularly well. This high valuation shouldn't surprise us completely, as the S&P 500 has climbed 34% since its April low this year, giving us double-digit gains for the year to date. Technology stocks have led this rally, with the Magnificent Seven stocks up 61% since the bottom. And here's what's important to understand. Valuations don't predict short-term movements. They're not crystal balls that tell us what will happen next week or next month. Instead, they help us decide how to allocate our investments. So what's the good news? Not all parts of the market are equally expensive. And this creates opportunities for investors who look beyond just the popular stocks and think long term. Now let's talk about what the Federal Reserve is doing and why that matters. So the Fed cut interest rates by a 0.25 percentage point in September. This resumed their rate cutting cycle after holding rates steady through most of the year. And what makes this cutting cycle unusual is that it's happening while the economy is still growing and markets are at all-time highs. And normally, the Fed cuts rates when there's a crisis or a recession, kind of like how you usually only call a plumber when there's already water on the floor, not as a preventative maintenance. This time, they're trying to normalize policy after raising rates rapidly starting back in 2022. The main reason for the Fed's decision has been the weakening job market. So as you see in the chart here, this chart shows preliminary payroll revisions. And the data suggests that 911,000 fewer jobs were created over the past year than originally was reported. So the Fed is trying to get ahead of potential weakness here, rather than wait for a crisis. For investors, rate cuts usually help both stocks and bonds if the economy stays strong. Finally, let's talk about what recent market swings and policy uncertainty mean for your portfolio. So after big swings caused by tariffs earlier this year, market volatility and economic policy uncertainty have improved significantly. However, as many long-term investors know, calm periods can change very quickly. So current events like the government shutdown and ongoing tariff talks could create short-term volatility, even if their long-term effects are small. And for investors, uncertainty may feel uncomfortable, but it's also what drives long-term results. The last several years show a big difference between what investors feared and how markets actually performed. It's the investment equivalent of worrying about a storm that neither arrives or turns out to be a light drizzle. Rather than viewing uncertainty as something to avoid, successful long-term investors recognize it as just a normal feature of markets that creates opportunity. So I hope these insights help as we enter the fourth quarter. And if you want to learn more about any of these topics or discuss how they relate to your specific situation, please reach out. That's what we're here for. And if you found this helpful, please subscribe. We're working to make complex market topics understandable without all the jargon and fear-mongering that usually comes with financial news. Because investing is stressful enough without needing a finance degree just to understand what's happening. So I appreciate you watching.